Hello, in this presentation we're going to talk about how to make loan payments within QuickBooks Pro 2018. If you've been working along with us, that's great. We'll be working along with the Get Great Guitars problem. If not, that is okay. We'll show how to make a loan payment, including the recording of interest and expenses while making that loan payment. If you have the backup file up to this point, you can restore that by going to the File and Restore. That backup file or working through this problem and getting to this point will be helpful so that we're on the same page and working with the same data. But if that's not the case, again, that's okay. We can follow through this and get some relevant information from the process of recording a loan payment. What we're going to do is write a check for a loan payment. The tricky thing about that, however, is that when we write a check for a loan that we have taken out, there's typically going to be at least part of it allocated to principal and part of it allocated to interest. When that's the case, we're going to have to split the two accounts that that payment is going to, and we'll discuss about how to do that split and why we're going to do that split, and then what's it going to look like on the financial statements. So in order to do that, let's first look at what we have so far. So we're going to go to Reports on the drop-down. We're going to go to Company and Financial and look at the balance sheet in terms of the loan that we have at this time. I'm going to change the date to, I'm going to customize the date and make it for the year of 01/01/21, January 1st, 2021, and we'll make that go through 12/31/21, and okay, so we're going to be working in the future, and we have this balance here in terms of the loan, scrolling down to the liabilities, this balance here in terms of the loan. Now this is a loan that we took out and we're making payments on it. There could be a variety of different ways that the payment could be set up, that it's in accordance with the loan. It's not typically, it doesn't have to be, in other words, just like a mortgage payment in that we're paying principal and interest back on a monthly basis. That's one format of a loan. We might just be paying only interest back and paying the principal back at a later time, or many different combinations of that. However, let's take a look at the typical situation in which it'll be similar to a mortgage, where we have principal and interest payments being made on a monthly basis. And think about, well, when we make those payments, we can't just decrease cash and decrease the loan, because when we do that, what's going to happen is we're not taking into account the interest. And we can't just make the payment and record it all to interest, because when that happens, we're not taking into account the decrease in the principal. We're going to have to somehow split that out between the two. That is what we are working on here. In order to do that, we first need to know what that split is. And to have that, we need an amortization schedule. When we get the loan, we may not have an amortization schedule when we get the loan. We might just have the terms, and we might have to build that amortization schedule. So first, let's look at an amortization schedule. We'll actually make one and see what we're talking about, and then we'll take that information and record that here using the split and see what happens. Here is our data in Excel. So we have the data within Excel. We have the 72,000 loan. We're going to say it's for 5 years, and we're going to pay monthly. So 5 times 12 means we're going to make 60 payments, and we're going to say the rate is 5%. On a typical loan, that's going to be the type of information we have. We may or may not even know the payment. We probably know the payments too, but we're going to calculate the payments here. And then we may not know, what we don't know is the split between interest and principal per payment, because that will vary, that will change as we go. So first, let's do this calculation for the payment within Excel. We can see how to calculate the payment, and then we'll have to calculate for each of those payments, those 60 payments, the individual split using an amortization schedule, and show how that would be broken out. So let's do that now. This is something that if you don't have this, you can get it from your accountant or your CPA can help you with this. We'll also take a quick look at some other ways you may do this, and then look to adjust it at the end of the year with possibly your adjusting department or your CPA in order to account for the interest portion of any loan, as well as the short-term and long-term portions of them. So if we have the payments is going to be the calculation. One way we can do it here is we can go to the formulas, and we go to this functions tab, and if we type in payment, then that usually brings it up. It's this PMT is what we're looking for. That's the payment calculator. So if we know the loan amount and we know the how many months and the rate, we then have everything we need except the missing variable of the payment for this calculation, and Excel will do that for us. So we're going to say OK, and we get this nice little function entering box that will help us do this. We'll take the rate. It's going to be that 6%. However, we're going to break this out by the number of payments which are being paid monthly. So we really want the monthly rate. So we're going to take that and divide it by 12. That's the trickiest piece of this calculation. Remember, whenever we think of a rate, it means per year. So we're going to divide that out, and that'll give us the rate per month in this case. This is going to be the number of payments, number of periods, number of payments. And we're going to say that that's going to be the 60. It's going to be 5 years times 12 months, which is 60 payments. And then we're going to say the present value is what we have right now, the 72,000, and enter. And it gives us our amount. I want to see it as a positive number rather than a negative number. It puts a negative because it is a payment. In order to flip the sign, all we need to do is go in front of the P in the formula and put a negative. And that, in essence, will take the whole thing and make it negative, or take the whole thing and multiply it times -1, making it negative. Now there's another way you can do that, just to show you how Excel will do that. If you say equals PM, the payments tab, or click on that, then we got this nice little thing down here that shows you what we're working on. So it's actually a quicker way to do it. You can take the rate divided by 12, comma, and then it wants the number of payments, which is that 60, comma, and then it wants the present value, which is that 72. These are not required fields, so we're going to close that up, and that'll be it. So now that we have that information, that's great. I'm going to make it a negative too. I'm going to make it a positive by putting a negative in front of the P, like so. That's going to be our payment amount. Now that's what we're going to write the check for now. We probably already knew that that's going to be in our loan terms. We probably know this information, but we don't know how to split that payment between interest and principal. So let's think about that now. Let's break this amortization table out. I'm going to say the payment amount is going to be this. For payment number 1, we'll calculate the interest as equal to the principal amount times the 5% divided by 12. That's how much interest we should be paying for the first installment 1 month from the date of the loan. If that's the interest amount, the principal then is the payment minus the interest. So the principal is going to be the payment minus the interest. So I'm just taking the B7 minus C7 will give us the principal. Then our new principal amount is going to be equal to the 72,000 minus this decrease in principal. So after our first payment, we still owe 70,941, and we had the payment of 1,359, but broken out between interest of 300, principal of 1,059. Payment 2, if we do that same calculation, we're going to say the payment is constant. That's what we said was going to be constant, but the interest now is calculated on this new lower principal amount, because we're basically paying rent on the lower principal, times this 5%. I'm going to say F4, so when I copy that down, it'll keep that cell. Tab. And then we're going to say principal. Oop, wait a sec. That looks awfully high. And that's because we didn't divide it. I did not divide it by 12. And so there's the new principal. The new interest is a bit lower. There's our payment minus the new principal. There's the principal reduction. And we're going to take the prior principal minus that deduction, and that gives us our new principal. So now of course, the principal is going down, but not by the amount of the payment. That's how much cash went down. 296 of it was interest, and therefore the principal was 1,063. If we do this again, one more time, 3, the payment's the same. The interest now is the new principal times the 5%, F4 to make it permanent. That just means the dollar signs just means I want that an absolute reference. So if you don't know, don't worry about that now. We can look that up in an Excel course. But you need that there when we copy it down. Divided by 12. and then the principal deduction is going to be equal to the payment minus the interest. The new principal, therefore, is the prior balance minus the principal deduction. Point being that the interest is going down with each payment as the principal that interest is calculated on goes down, and the principal portion then being applied out, part of the payment is going up. Now I'm going to copy this down all the way down to 60 payments, and we should get to a principal balance of 0 after 60 payments. So let's do that. We're going to copy this down somewhere like around here. There we go. And so there's the 0. So we made 60 payments. It goes to 0 at that point in time. That last payment, we still made the same amount, but the interest portion was only $6. All of it was principal because we only had that much that was being calculated interest on, bringing the balance down to 0. So this is an amortization table. This is what we need in order for us to say, okay, we're on this first payment, and we need to make that payment. We're going to say it's for $1,359. So we're in essence going to just write a check for $1,369. However, we need to split the other accounts between interest and principal. That's what we'll do now. So we're going to go back to QuickBooks over here. We're going to make our first payment. So I'm going to do that. There's a couple different ways we're going to do this. I'm going to do this in the check register, and then we'll actually write a check. So we'll go to banking. I'm going to go to use register. We want to be on the checking account and say OK. Here is our check register. Going to make this payment as of 02/01/21, the first day of the next month. And I'm going to say that that's the check number should be OK. We're going to say that remains the same. The payment is going to go to Chase. We're going to say Chase, and the payment's going to be for the full amount, 1359, the full amount on our amortization table. Now we only have one other account, and this is the problem when entering this data. We need two accounts for it to go to, one for interest, one for principal. The way to do that is you select the split here within the check register, and now you can add up multiple accounts as long as this line, these totals add up to this total here. It won't let you post it if that's not the case. You can't really mess that up. So we're going to say that there's going to be an interest expense portion. Notice interest expense does pop up from our chart of accounts. We had not made that. It was there and generated from when we created this chart of accounts as a merchandising business. And it is an expense. That's what we want. So we're going to say that's what we want. That amount, however, is wrong. It's going to be 300 from our amortization table. And then we're going to say that the other amount is going to go to the loan payable. And so there's loan payable. It's a long-term liability. And QuickBooks figures it out for us. We could have gotten that from the table, but QuickBooks figures it out for us. Now let's just pretend we got it wrong here, and I put 1,000 on accident. And if we try then to record this, QuickBooks is going to say the transaction is out of balance. We're not going to let you do that because it's wrong. And we're going to go, all right, it's wrong. And then we're going to figure this out. The second one, we're going to say that that came from our table of 1059. And that then should match this amount as it does, I believe. So if there's no pennies involved there. So we're going to say record, and there we have that. So this amount has been recorded. If we take a look at what happens then in terms of the financial statements, we can start with the balance sheet, going to the balance sheet here. And we know that the cash went down. Double clicking on cash. We see that cash should decrease by the full amount of the payment. Double clicking on that. We see the check here. Closing this out. Closing this out. We then go to the income statement or profit and loss. We can see the other two accounts. Reports, company and financial, profit and loss. We're going to change the date 01/01/21 to 12/31/21. And we're going to look for those two other amounts, one being the interest expense. There's the 300 in interest expense. There's the 300 there. So there's our check. Closing this out. Closing this out. That, of course, decreases net income. And I misspoke before. I'm looking at the balance sheet as the other accounts. Let's go back to the balance sheet. And we're going to scroll back down, and we now want the loan. Here's the loan amount, $70,941. Double clicking on that. We see that check right here. And note we started with a loan of 22, and then we updated our loan terms by the 50 to get to that 72. So we're assuming that the new loan was negotiated at the 72. If we double click on this, there is our data. And if we close out of this, then we could check this by saying that amount should match the amount on our loan table here. So that's how we want to take a look at that. Now, note that if you were to do financial statements, you'd still have an issue that here is in long-term liabilities. And we would have to, after each payment, really, if in a loan like this, is figure out the current portion. So if you were actually to make financial statements, you'd have to be specific and say that there's still these amount of payments that are current, or the principal payment, the principal portion that is current, 12 months out, and take that number. Let's sum it up this way. And that number then is what would have to be the current portion versus the long-term portion of the loan. So beware of that, but just note that the total loan balance is going to be this if we split out between those two payments. So we're going to do this again, and we'll do one more payment as of the end of the month for the second payment, and we'll do that a bit different way. Back to QuickBooks, we're going to go back to the home page, and this time we're just going to write the check. So we're going to go to Write Check to write this second check, and this one we're going to write as of the end, so it's the second payment that we made. Happen to make them in the same month, one at the beginning of the month, one at the end of the month. So we're going to say it's the checking account. The check number should be accurate. We're going to keep that. We're going to say the date, however, is 02. I'm going to say 28/21. And so that's going to be the date. It's going to go to Chase again. And note that we already have Chase set up as an other, not a vendor, not a customer, but other, the person we took the loan out from. The amount is going to be the same, 1359, same amount. And however, we're going to break that amount out between interest and principal, a slightly different format. So once we have that breakout, we can't just copy the last check is the point. We have to go back to the amortization schedule because that breakout changes. The interest now only being $296, and cancel account interest expense tab only being $296, and the principal for the loan, then the difference, this should be $296. And the principal, the loan difference, is 1063. So note they're slightly different. It was 300 before, and it was 1059. Now we have the interest expense 296 and 1063. We're going to save and close this. Note that when you look at the check, we already have those breakouts down here, so we don't have to use the split column. And you got to remember that we're always on the expenses, typically, unless we're dealing with inventory when we write a check. So we're going to say save and close, and let's see if that did what we would expect it to. I'm going to say no to the advertisement to get checks, which is a nice thing to consider, but we're not going to do that at this time. And we're going to go to the balance sheet, and scrolling back up, we can see that cash is here. If we double click on cash, we can see that cash has decreased by that same amount, the second payment, same amount. Double clicking on it, there is our check. Closing this back out, closing this back out. Profit and loss. Scrolling down to the interest expense, there it is. We see that second check for a slightly different amount. There's our check. If we close this out, back to the balance sheet, and we check the loan balance, we say here's our long-term note loan payable. Double clicking on that amount, we see our check again, decreasing that by a different amount. Double clicking, there it is, closing back out. This is of course in accordance with the amortization table. Closing back out, balance $69,878. If If we go back over here, we can see that we're just made our second payment right there. Balance $69,878. Again, if we were to show this to someone else, we would have to then adjust after each time, because note that the amount that's due, the principal portion due within 12 months, changes after each time period. So we'd have to say that the current portion is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out, and break that portion out as current and the rest of this $69,878 as long-term. In order to show that, we'd have to make that adjusting entry at the end of the month if we were to report these properly in terms of current liabilities versus long-term liabilities. Also note, you might be saying, well, why aren't we adding this up? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And if we were to do that, it would remain constant given the fact that we're paying the same amount each month. But the reason we don't do that is because this interest expense has not been incurred yet. So as of this point in time, we have not yet incurred this interest expense because time hasn't passed. Just like if we were renting an office building, we're not going to charge the rent that we know we're going to pay in the future. We don't owe that rent yet because we haven't yet used the office building. So these payments include assumptions that we're going to be using or borrowing the money, and we haven't. So we can't record it on the balance sheet as of this date. We can't include the interest portion that is on the balance sheet as of this date, because we have not yet incurred the expense by time passing with which we are using the purchasing power of the money. Gonna pull this back out. So that's going to be the interest calculations. We could set that up. Just note that if you're working with a CPA firm or a bookkeeping firm and you're making payments and you're saying, I don't know that amortization schedule, and maybe that's too complicated and I don't want to make an amortization schedule, then you could get an agreement with your accountant firm, especially if you have a lot of loans. And you might come up to an agreement and say, hey, you know what, I'm just going to post the payments to these particular loans. And you'll see them all there. When you double click on the loans, you'll see all the payments that I've made to this loan. And and I'm going to break out each loan individually. Could be useful, helpful to a process like this, and tell your accounting firm that they need to make an adjustment, or you would appreciate them to make an adjustment at the end of each month in accordance with the portion of this loan that needs to be reported as interest before the financial statements are used to make decisions on, and the current and long-term portion needs to be broken out. So that's another way a system could be set up to run this efficiently. Just say, hey, I'm doing the checks. I write the checks. I'm going to write the checks to the loan, and then I expect my accountant or bookkeeper monthly to go in there and make that adjusting entry on a periodic basis.